Banks like Wells Fargo are not our friends, and we're going to learn in this video how consumer debt is becoming a major problem for home buyers across America. And to be more specific, consumer debt like student loans, auto loans, and those high-priced credit cards are a bigger problem now than ever before. And the worst part, this debt is destroying our savings accounts and preventing Americans from saving money. And for home buyers that are now looking for a home, this increased debt is causing you to pay even more for a mortgage because of the debt to income ratio. And this is when you actually are starting to owe more than you make. So in some cases now, I'm seeing home buyers paying almost 7.6% for a 30-year mortgage, and that's with paying up to 3 points just to get a loan. And with this record inflation, with the lagging wage growth through the years, our problem now is we're seeing consumers putting life's essentials like their groceries or utility bills, their car expenses, their home repairs, and gas on these expensive credit cards. Welcome back and thanks for watching. If this is your first time with Sachs Realty and you like it here, I encourage you to go ahead and subscribe to our channel. That way you'll stay up to date with anything and everything that affects the real estate market. Now I want to start off this video by showing you this important chart that sort of sets the stage for our discussion. Because though consumer debt has been around in one form or another for a very long time, as history books provide, consumer debt in our lifetime has never been such a problem as it is right now. Now, this Fred chart is on consumer loans, credit cards, and revolving plans from all commercial banks. This chart shows us that as of January 4th, consumers owe more than $940 billion in consumer revolving debt. That's only $60 billion away from $1 trillion in consumer debt. That's 12 zeros, friends. Now, this chart dates back to the year 2000, and I don't think for the purposes of this discussion, we need to go back any further than that. Now, before we start to talk about how we may be setting ourselves up for one of the largest times of personal bankruptcies in history, let's take a look at this December article from Reuters.com, where they reported that according to the forecast of credit reporting agency TransUnion, they believe in 2023 that U.S. consumers will fall behind on personal loan and credit card payments at the highest rate since 2010. This financial burden is certain to affect the housing market, and I believe we'll see a housing market crash for the second time since World War II. And if consumers don't act quickly to reduce this type of consumer debt, and I'm talking about selling things that you don't need, guys, to do so, consumer debt may create even less home ownership in the U.S. and force foreclosures for those not able to make their monthly mortgage payments, as well as the other housing-related costs that go along with owning a home, like repairs and maintenance. Now, before we go any further, let's take a look at how Americans are doing with saving money. Now, when I look at this chart from Fred, based on the information from the U.S. Bureau of Economic Analysis, I often wonder why is some information provided to us more accurately and, recently in time versus other data like this chart that's only given us information since November of 2022. Maybe it's because things are actually worse now and they just don't want to report it. But anyway, guys, let's take a look at what they do provide us. And that is, as of November of 2022, we are saving money less than we did in history all the way back to 1959. But you can see here that during the pandemic period in May of 2020, look how high this is. I believe this is because we've never experienced government stimulus like we did during the pandemic, when people were making more money on unemployment than they were at their actual job. Then what happened? We went from having the most savings in history in our bank accounts all the way down to the worst in just 2 short years. What caused this depletion of all of our money? Well, I can tell you guys, it's because we are spending too much money. We need to start waking up seriously, and we need to take better care of our financial situation. Because guess what? No one else is going to do it. It's like working out at the gym. If you don't do it, no one will do it for you. And we have to get out of this trap that these greedy banks are just simply luring us into to take all of our hard-earned money. Now, I just mentioned earlier in this video that TransUnion, and they know a lot about our credit, guys, and they know a lot about our ability to pay loans back. They are predicting that we are going to see this year the highest loan delinquencies that we've seen in 13 years. That takes us back to about 2010. Now, in this article I'm about to show you, published by Forbes.com back in 2012, it was titled, How Banks Are Getting Rich Off of the Poor. And the reason why I think we need to pay attention to a little bit of the history books in this case is that this article reports that at the end of the day, though, a bank's got to do what a bank's got to do, and that's make money. And guess what? One of the ways that a bank can make money is by offering low-income consumer products laced with loads of fees and plenty of interest. And one of the banks that had issues back then with sort of like predatory lending is a bank that's back in the news today, Wells Fargo. The article goes on to tell you that some banks, namely U.S. Bank, Regions Financial, and Wells Fargo, are luring low-income consumers to sign up for things such as prepaid debit cards and payday loans, products that typically come with all sorts of fees and charges. Nancy Bush in this article, a bank analyst, puts it this way. It goes back to the way some people have viewed banking. They treat banking like an electric utility where if you flip the switch, it has to be there for you. But the truth is, banking is a business that aims at making profits for the shareholders. So now, when did we as Americans buy into this we should be in debt theory? And to go along with that, when did we think that actually paying triple or quadruple or 10 times the amount for a product or 3 times the amount for a home, you get my point, is a good idea? Well, I guess it all started with the introduction to what we know as credit cards. And guys, what credit card lending does actually is it makes it less painful for us to make a purchase, right? We go out, we're like, yeah, we don't have to pay for it now. We don't have the cash in our pocket, but it's in hope that you will make more money or miraculously more money will appear. I don't know. Maybe we'll just get raises unexpectedly, as some do. But, this is a lure that has really gotten us into big trouble. So I want to take us back to the first modern credit card that was actually introduced in 1949. It was called the Diners Club credit card. And guys, I have to say I'm old enough to remember this. Select men could use this prestigious card to impress those that were with them while dining, and 27 restaurants had bought into this, so where you could go to one of these 27 restaurants and not have the money in your pocket, but you could pull it out, impress your friends by charging it. And this credit card actually became internationally accepted in the UK, Cuba, Canada, and Mexico. Now, we're only talking about dining here so far, but back in 1958, Bank of America was actually one of the first banks to offer credit cards to their Californian customers. And it was named Bank AmeriCard. Now, this was the first credit card of its kind offering a revolving consumer debt. The card went on to later be renamed Visa. And a few years later, back in 1966, a few California banks got together and formed the Interbank Card Association. And together they formed Visa's competitor, then called MasterCharge. This card was then renamed in 1979 to MasterCard. And just to show how discriminatory things were just 50 short years ago, up until 1974, women were not allowed to get a credit card on their own without a male cosigner. Now to bring it home, guys. For those of you that don't know, I'm a real estate broker here in Maryland, and I deal with buyers and sellers every single day. And I have to tell you, I am shocked at the fact that I'm still seeing FOMO, the fear of missing out, amongst home buyers. Now, guys, this is despite the fact that the Fed is stating numerous times in 2022 that a housing price correction in America is needed. And also mainstream media has been reporting over and over again all about the overpriced housing market. And now that we've seen mortgage rates almost triple since their all-time low just about a year and a half ago, buyers are still going into a frenzy with the limited home supply competing for overpriced homes. This is creating an entire problem by itself because these over-anxious buyers are making the housing price correction nearly impossible. This problem is creating stagflation that we haven't seen since the 1970s. So if you're in the market buying a home right now and you're experiencing what we've talked about as high consumer debt, my best advice is that rather you look for a home right now, that you take a step back and start getting aggressive on reducing the amount of consumer debt that you owe, because I think that better home prices are coming, as I believe that this temporary increase in demand is going to quickly be chased out by the fact that consumer debt is an increasing problem that is going to single-handedly take this housing market down. All right, guys, thank you so much for your time and watching this video. And if you like this video, you can let me know that you did by hitting the thumbs up. And as I mentioned before, if you haven't already subscribed to our channel, consider doing so now. Hit the alert bell. You will be notified every time I upload real estate content just like this. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.